I will explain several points regarding bank health. 1. Introduction to bank health. Definition of bank health. Bank health refers to the ability of a bank to operate effectively, maintain financial stability, and earn the trust of the public by safeguarding deposits and providing loans. A healthy bank plays a vital role in the economy, particularly in managing liquidity and supporting economic activities. Importance of bank health. A healthy bank ensures national financial stability, protects the interests of depositors, and contributes to the economy by effectively channeling credit. Conversely, an unhealthy bank can trigger financial crises, as seen in various countries during bank collapses. Role of regulatory bodies. In Indonesia, the Financial Services Authority (OJK) and Bank Indonesia (BI) oversee the health of banks. They regularly evaluate and monitor bank performance to ensure compliance with regulatory standards. Point 2. Key indicators of bank health. Several key indicators are used to measure a bank's health. Capital adequacy ratio. CAR measures the sufficiency of a bank's capital to cover its risks, such as credit risk and market risk. A higher CAR indicates that the bank is better equipped to absorb potential losses. OJK sets a minimum CAR requirement of 8% to 12%. Non-performing loans. NPL measures the percentage of bad loans that borrowers are unable to repay. A bank with a high NPL indicates poor risk management. Ideally, an NPL ratio below 5% is considered healthy. Return on assets, ROA, and return on equity, ROE. This measures how efficiently a bank generates profit from its assets. The higher the ROA, the better the bank is at utilizing its assets. ROE measures how effectively a bank uses equity to generate profits. A higher ROE reflects good capital management. Loan-to-deposit ratio, LDR. This ratio shows how much of the deposits collected by the bank are being disbursed as loans. If the LDR is too high, it means the bank may be overlending, which can be risky for liquidity. Ideally, LDR should be between 80% and 90%. Operating expenses to operating income, BOPO. This ratio measures the bank's operational efficiency. A lower BOPO ratio indicates that the bank is managing its operations efficiently. Point 3. Camel's approach to assess bank health. One of the methods used to assess a bank's health is the Camel's approach, which covers 6 key factors. C. Capital adequacy. This measures the strength of the bank's capital to absorb losses. A bank must have sufficient capital to protect itself from risks. A. Asset quality. This assesses the quality of the bank's assets, especially in terms of loans given. Poor quality assets, such as bad loans, negatively affect the bank's performance. M. Management. This evaluates the quality of bank management in handling risks, finances, and operations. Good management maximizes the bank's potential and mitigates risks effectively. E. Earnings. Stable and sustainable earnings are critical indicators of bank health. This shows how well a bank generates profit. L. Liquidity. Liquidity measures the bank's ability to meet short-term obligations, such as customer withdrawals. A healthy bank should have adequate liquidity to avoid defaulting. S. Sensitivity to market risk. This evaluates the bank's ability to handle market risks, such as changes in interest rates or currency exchange rates. Example of a Camels-based bank assessment. If a bank has a high CAR, low NPL, and good liquidity, it will be considered healthy. On the other hand, if a bank's management fails to control bad loans, leading to a high NPL, the bank's performance will be rated poorly. Point 4. Case study of bank health in Indonesia. Case of Bank Century. 2008 Bank Century serves as an example of a bank that failed to maintain its health, eventually requiring a government bailout. The